So that call declined quite a bit. But what happened to the put during the same time, an out-of-the-money put? With corn declining 75 cents, the 280 put went from $500 to $50 today. Same thing. And why did that happen? Because, I'm sorry you can't see that this well, but this chart of volatility, you can see, I hope you can see it diving. Option volatility in corn has declined 50% from its highs. You can't buy a put option, even being right on the market. You can't buy a put option and make money. Maybe some of the close to the money options, maybe they made money. I don't know. I don't have it tracked completely. But why put yourself in that position of guessing correctly or predicting correctly or analyzing correctly to the direction of the market, being right, and still having a significant opportunity of losing money? We don't want to put yourself in that predicament. Okay. That's the reason I use neutral positions and ratio spreads. Those are the two positions I love. They're my favorite positions. Ratio spreads are actually my absolute favorite position, but they're not as frequent. They're not as frequently available as neutral positions. Neutral positions, we probably have 2 or 3 on every week, and maybe a new one every week or two. So there's plenty of neutral positions. Bonds are the best trading market for neutral positions. Now, a neutral position is selling a put and selling a call in the same commodity. And we're going to move on pretty quick now because we just have about a half an hour. And in this case, we're selling a bond 104 put and 122 call. We like to, if possible, sell them outside of the 6-month range of the market, below 6-month lows and above 6-month highs. No secret in that, just my plan. If possible, I like to do that. Can't always do it, but I like it a lot better when we do it. So what we do is we sell them outside the 6-month range. Generally, these options are overvalued out of the money options. If they're not, we have no reason for selling them. We take advantage of the time decay of both options. The time decay I discussed that happened during that report, that's an example of time collapse, not decay. But actually what happened is when you buy an out-of-the-money option that has no value, if you buy a gold $400 call today with gold, cash gold at 380, what value does that have? If you exercise that option, you're long gold at 400. You wouldn't want to do that because you can buy gold at 380. You don't want to be long gold at 400. So the only value an option has, an out-of-the-money option has, is time value. Problem is, every day, every minute, that option is decaying. So we sell a put and a call out of the money. Doesn't matter what the market does. Every day, both of those options lose some time value. That is one of the major benefits of the neutral position. Also, markets do not trend most of the time. I put 60% of the time. Studies have shown up to 80% of the time markets do not trend. If you sell a neutral position, you sell a put and a call, and the market doesn't trend, you could go into a coma and wake up, and your position is now profitable, so you don't have to do anything. If that's what really happens. Now you have the ability to adjust the position, and it's not necessary to predict market direction. Now we talk about adjusting the position. Here's an example of a 110 put and 120 call neutral position, the one on the left. So we're basically saying that we expect the market to stay between 110 and 120. Okay, again, you go into the coma, the market stays there, you win. Now what happens, but remember that what I always look for is what's the worst thing that could happen? Well, the worst thing that could happen is the market starts taking off. In this case, the market moved towards 120. Our adjustment level on this point was 118. So we always set a standard below, before it hits the absolute outside of our boundaries. In this case, it was 2 points on either side of the option going in the money. So we said, okay, bonds went up to 118. They might be really taking off. Maybe this is the 20% of the time that they're going to trend. We adjust our position to the 114, 124. Okay, we move with the market. No law that says we have to stay with our initial position, that we entered into a position and we said it was going to stay there. Well, markets change. You need flexibility. You have to have flexibility. There might even have been reasons to get out of this position entirely. If circumstances change, if I put on a position on Tuesday, and on Wednesday some facts are brought to my attention, and let's say I don't care if the position's at a profit or loss, but something's brought to my attention that makes me change my beliefs, I will close that position out on Wednesday, because every day is a new trade. If you put this position on Tuesday, and on Wednesday you have new facts, and you keep that trade, well, you're now entering into a trade that you don't want to be in. So any day you look at your trading log, you have a trade on that you wouldn't put on that day, you should be out of it. Anyways, on Wednesday I see I should be out of this trade because it's unbalanced. We adjust it. We adjust it to the new range. Now, most of the time when we adjust our positions, it's unnecessary because the market, to its natural tendency, sort of drifts back into the old range. And what happened actually in this position is the market expired below 120. So we unnecessarily paid a little bit of fees and commissions to adjust our position. We pay them too. We have to pay the floor traders and the FCM. We unnecessarily paid it, but what I was able to do is sleep a lot better knowing that I had a more balanced position that had a higher probability of profit. Here's how these positions work, and now we're going to get, as soon as we finish this, we're going to get into some real-time analysis of trades over the last couple months. This is back in '93. Shows the bond market moving in October from 104 down to 100, back to 104 again. Pretty normal movement from the bond market. Bottom chart on the left is an out-of-the-money call. Bottom chart on the right is an out-of-the-money put. These are real-time charts. What happened to both options as bonds chopped around, as they usually do? What happened to both options? They went from, the call went from about $800 to $100. The put went from about $2,000 to a couple $100. They both lost value. They both decayed in time value. Also, we had the benefit of volatility moving down, which is nice. But all that does is accelerate the decay. We still would have done just as well, even if volatility didn't decline, because time decay just ate up the money. The bond market didn't make any significant move. Is that a one-time deal? Here's June of '96. Now it's a little spotty because they didn't have that many trades, but here's bonds. In fact, here's even a worse picture because bonds moved from 120 to 112 in February, March, and that should have really hurt us quite a bit. Well, the call on the upper left, the call went from $2,000 down to worthless. The out-of-the-money put, though, went from $800. It also went down to worthless, too, because bonds still didn't make a big enough move to impact the far out-of-the-money put. So that's up to date. I mean, this happens, and I wish I had a chart of our last experience 2 weeks ago. I mean, that would have shown in one day the same premium decay that we had in months in these charts, which is an absolutely fantastic opportunity. Doesn't happen often, no. It doesn't happen often, but why not be there? Why not be there for that one? Why not be there for the ratio spread? You're going to see an example of coffee ratio spreads that are just basically unbelievable. They're such a high probability of profit. Okay, how do we analyze our trades? We said first thing we look at is volatility. Looking at the S&P this year, what did we see? We started to see, starting in January, we started to see a rise in volatility, a significant rise in volatility. What does that say about the underlying market? Where's the market going? I don't know. I don't have a clue. I have no idea where it's going. All I do know is the premium of options are going up, and I better look at that market to see if there is any significant opportunity. What we then do is we start doing our analysis. We have our bookmaker software which analyzes the market, and here we plugged in an S&P neutral position of selling a 625 put and a 700 call here. And we have basically we have two rankings we look at. One is the probability of profit, which in this case was 83.5. And then we have a bunch of other parameters that we run this trade against, which is it below 6-month highs, above 6-month lows, the options we're selling, the safety factor, we compare it to past trades. So we run it against a bunch of other variables too. And unless both of these are fairly high, we don't do the trade. Probability of profit could be 90%. In fact, many trades we run has a high probability of profit, but we get a low bookie ranking. Either we're not taking in enough premium, there's some other factor that just doesn't make it a great trade. So this is not something, we don't run 10 trades and get 9 of them like this. We get much, we probably run 10 trades and get 2 of them, maybe 1 of them that looks this good, and a few of them that are sort of borderline. So when we start seeing volatility go up, we analyze the trade. Here's another, we analyzed another position here. This was the 615, 695. This one came out at 85%. It's another type of chart we use. Yeah, this one's similar. So we put that all together in our newsletter. We have our Trade Like a Bookie newsletter, and we write our analysis of the market. And in this case, not only was the volatility going up for the at-the-money options, and that's the volatility figure that we use when we say volatility is at 15%. If the S&P is at 680, we are averaging the volatility of the 680 put and 680 call. But what we're not telling you is what's happening with the out-of-the-money options. And what was happening, and it still is happening, is the out-of-the-money options were 20 to 50% higher in premium. So selling the out-of-the-money puts and calls had a considerable higher probability of profit. We finally settled on selling the 610 put and 695 call, and this trade had a 90% plus probability of profit. And here's the profit range. Here's the upper graph that shows the profit range of this trade. Profit range was at 1-year lows, way below 6-month lows, at 1-year lows, and way above contract highs. Okay. Now, could have we lost on this trade? Sure. Sure, we could have lost that. You can lose on every trade, but the odds were substantially in our favor. And that's the only way that I can trade is by the odds. Because I don't know where the S&P is going to go. I'm not good enough to know where the S&P is going to go. What happened to the premium on these options? Again, we're not going to spend a lot of time on it, but upper left put, upper right call, real time, they both dropped off. Time decay, nothing fancy. I'm going to skip over to the coffee because I have a demark I want to show you. But let's look at the coffee, which was really a pretty spectacular opportunity. Coffee option volatility chart on the bottom. I looked at that, and you know what I saw? Very little. I really didn't see a whole lot because volatility in coffee was pretty standard at 40%. So really, no trade indicated from the volatility chart. But one of my course members in our group, which is pretty advanced, called me up and was basically faxed me over a note, basically panicked. He said, "Have you seen the out-of-the-money options in coffee?" And I said, "No, I don't. I can't. We can't track everything. It is not possible. We have computers running all the time. We have strategists, but we miss trades, and that's why we love having more people involved." Anyways, the at-the-money options in coffee, we're at about 44% volatility, 47% for the calls. Pretty high. It was moving up. So it was averaging about 45%, just like we saw on the chart. But look what was happening at the out-of-the-money options. 100%, 98%, 105%. Look at those numbers. I mean, they were 200% to 250% higher than the at-the-money options. That is significant. That is amazing. I mean, we were selling coffee. We were selling positions that, and in fact, they were even. This is not even close to the highest that they were. But we were selling. I know for quite a while the 100 puts and 200 calls, the 90 puts and 200 calls that were so far from being. Here's actually a profit range on a coffee chart of where these positions were. In fact, the upper one isn't even close to where the calls. As far up as that chart went was about 165. So the actual profit range is much higher that's on the chart. The probability of profit computed out to 96% on this trade, but at times we got 98%, we got 100%. We were doing ratio spreads using it. An incredible opportunity. We had so many coffee positions on that at one point I closed them down. I said no more new coffee trades because if something happened, which I didn't know what it could possibly be, could happen, I would be drinking coffee for the rest of my life, morning, noon, and night. But we had a significant, huge number of coffee trades on because it was such a great opportunity. Does it happen every day? No. Happened once this year. Bonds happened once this year. Those are the great ones. The good ones like the S&P, those are around all the time. Those are around 2, 3, 4 times a year. Bonds are around commonly. Let me show you another one. The currencies have been very, very good to us for the last year. Option volatility rose in the currencies mid-95, started coming off, perfect environment for neutral positions, high volatility, starts to come down. We started initiating neutral positions. We initiated neutral positions in the mark, in the yen, and in the franc. All of them were great. Here's an example. This trade had a 91.7% probability of profit. Look at the profit range on that trade. When the D-mark was at 6,800, we were selling the puts at, we're selling the 63 puts. We were selling the 73 calls. Above contract highs, substantially above where the market was then, way below contract lows. And we weren't collecting $50 or $100 in premium. We were collecting $800 to $900 in premium on a $900 margin. Compute that out on an annualized return. Add the annualized potential return to the probability of profit, and you have a great trade. You have an incredible trade. Now, those positions were available. We were doing those. I'm sure they were available before October, but we started doing them in October. And actually, I did, in my first bookie book, we did not include the currencies as a market that we wanted to recommend to other traders. And since then, we have included it because of the large potential overnight moves that it can make. However, if you get a trade on with this wide a range, there's no reason not to disregard this trade. So now we are using the currencies. However, we have strict standards. We have strict standards about all our trades. This is not, if you didn't have to have strict standards, you wouldn't need me. When I started trading in 84, 85, there was a guy that came on television every day, and he said, okay, the S&P today is at 300. We're selling the 320 put and the 280. We're selling the 320 call and the 280 put. And send me $20,000, and all my clients are making money. And if it moves up, we're going to adjust or do this. And you know what? He made money every single day until when? October 19th, 1987. And I never saw him on television again. He was gone. I don't know what happened. You got to have strict standards. You got to have really strict standards. And do I like selling S&P puts? I absolutely hate it. Absolutely hate it. We have very strict rules. And we scream at our clients to get out if they're in it against our rules, and we see anything in the market, we beg them to get out. We are concerned. So that's probably one of our biggest strengths is our concern in our money management. Finding these trades, that's the easy part. Between myself, our other strategists, and our clients and friends and my other people, we're always talking and comparing notes, and we find the trades. We find most of the trades. And you find them, and you put them on, and it's easy. You make money. But the hard part is staying out of trouble. The hard part is staying out of trouble. And our rules are very strict. And you know what? 8, 9 times out of 10, our rules are unnecessary. They really are. We closed out all of our positions in the financial markets in January when the government had its, quote, potential default and all these problems were going on in the bond market. We closed out all our positions. Why do I have to be there? Why do I have to trade? What was the law that said that I had to be in a market that had so much uncertainty? There's no law. There's no reason. I knew that there would be another day, there would be a better day. And if there wasn't, I'm finding a new profession. Because if there's no opportunity, I don't want to be there. Or if it's that tough, it's like if I was in a big poker game, a professional poker game, and my hand all the time was a pair of jacks and sevens. And that's the hand I had to play with all the time. And I couldn't get dealt anything else, I wouldn't be playing poker anymore. So if the opportunities failed to come about in option trading, I wouldn't be trading. I wouldn't be trading. So I'll just sit back. And you know what? There are times, if you take our old newsletters, we've been doing this since we've been publishing since 1984, you'll see some months in the newsletter where I apologize and I say, there's not a whole lot here. Go on vacation, go rest, go do something else. Don't trade. There's not a whole lot here. And there's months in a row that we've said that. It happens. Now, this month and the last couple of months have been great. They have really been great. There's super opportunities now. Right now, we have very high premium in the oil markets, in heating oil and in crude oil. And we have no idea where those markets are going to go. We are not the ones making those commercials to buy heating oil options. We are loving the people that are putting those commercials out. because heating oil options, the out-of-the-money options, are up to 40% higher than the at-the-money options, and providing us with ratio spread opportunities that have well over a 95% probability of profit. We've recommended those. We have neutral positions in heating oil. We have ratio spreads in crude oil. We love positions like that. And those are, let's see, what else do we just initiated a copper neutral position. Volatility in copper is still way up there. What about the currencies? I mean, the currencies have been great for the last year. What are we doing in the currencies? Nothing. Nothing. We haven't done any currency neutral positions for the last couple months because volatility is so low that if they start making a move, you will get killed. You will get, if you start selling currency option now, it's going to catch up with you. It's going to catch up with you. Now we do have people that don't believe that and have been selling it over the last couple months, and they've made money. They've done well. So I'm not the end. I'm not on top of the mountain yet. I have my own ideas. I have my own plan, and it works for me, and I like it. However, the people that didn't follow my advice in the currencies and continue to sell premium are making money that I'm not. I'm jealous. But you know what? Eventually, I think it could catch up with you. And that's why I like to follow my rules as strictly as I possibly can. Let me give you a couple tips because we're gonna run out of time. First of all, I know we've just gone over the basics, but what I want to impress on you is the real opportunities that are here. This is not an after-the-fact indicator. These are real opportunities, but you've got to know what you're doing. You're playing the game against me. Don't play the game unless you have the same amount of knowledge. Don't just go in and buy or sell an option without knowing what you're doing. Don't do it. Trade futures, trade cash, do anything else, but don't trade options until you really know why you're trading that option. However, if you have an aptitude for this, if you like this, it's the best opportunity in the world. Now, I was an overnight success in 12 years, and I knew in 1984 when I started this that in a year I would have thousands of clients, and everyone would know how great options are, and the options market would explode because I was going to let out all my knowledge. It didn't work that way. I had 99 subscribers at the end of my first year. My partner that started the newsletter with me, who's a big name, who by the way is a client of ours, and we trade for him now, he dropped out. He said, you're not going anywhere. You got 99 clients, and this is, get 99 subscribers in a year. It took a long time, but the opportunity is still, in fact, it's better now than it was when I started. It's better now. I see it constantly changing and evolving, and it is so much fun to do. To me, it's so invigorating to do this because there's a challenge all the time, but there's a reward at the end, not just money, but the discovery of these positions. And I learn something new all the time, just like I did 2 weeks ago in the group, where I'm sitting there, I'm concentrated, so focused on buying options. I'm so focused on buying options, and my group member says, well, why not just sell them? And I go, no, you can't do that, but you could. And I need people like that to supply. It's a great opportunity to get into. If anyone here is really seriously interested, we're always looking for either good traders or analysts or brokers, or we're always looking for good people within our company. We have a little over 100 people up in the Oxnard-Ventura area, and we're always looking for good people to work in our firm. So we're I'd like to put the word out, and we have found some of our best people, by the way, at these conferences. We'd like to spur the interest in someone because I don't think there's a better business opportunity in the world. I honestly don't. If you have one, let me know. I'll probably go in it with you, but it's a great opportunity. It's in its infancy. And I always put this out at my seminars too, that we will either give you $5,000 or our money to trade if you show us a trading system that has a higher probability of profit. That you can compute out, that shows by mathematics that will present trades with a higher probability of profit. We always put that offer out. I'm always looking for a better opportunity because, again, the bottom line in trading is not to look good, to have a name. You got to make money. The bottom line is you got to make money. So if there's a better system, a better way of doing it, I would love to do it. This is hard work. It is not easy work. Nothing that is easy is going to make you money. It's not going to happen. Just like a restaurant business, just like your own business now, you're all at some level of everyone here in this room, I am certain, is at some high level of success. Whether whether you're making $50,000 a year or whether you're making $500,000 a year, you're at some level of success, or you probably wouldn't be here. But you didn't get where you're at by buying 2 books and opening an account and trading on your first indicator that came about. None of you got successful that way. You worked at it, and you got to work at it in this business. But there's a misconception that options are so evolved, and there's so many gammas, deltas, and thetas you have to know. Frankly, I don't know them. I don't know them. I know volatility. I know how to use options. I know what works on and off floor. But I don't ever use delta, gamma, beta, theta. Any other letters out, Roger? I don't even know what those are. I don't use them. If you're going to be an arbitrager, yes, you do need them. But when I sell a neutral position in bonds of the 110 put and 120 call, now the technical trader will say, well, your delta on the put and on the call is 0.50. And when are you going to adjust the positions when they're 0.70 or they're, well, we have rules in our book that we discuss without going into the delta, gamma, beta. And it just depends on the premium of the option. It depends on where the futures market is, but you don't have to get that complicated. It isn't necessary to get that complicated. Also, again, be careful if anyone tells you there's any such thing as risk-free trading or stress-free trading. Those don't exist. Those don't exist, and it's difficult. It's good. I love it, but the rewards are there, but you've got to work. You got to work. Okay, let me do this. We have about 5 minutes left. Do we have any? I'll start taking questions if we have any questions from anyone. Start out. Okay, yes, sir.
On your neutral trades, do you ever use condors instead of strangles?
Question is, on neutral trades, do we use condors instead of strangles? I don't. I don't use condors. Now, there's a couple different ways that you could take neutral positions. The way I do it is generally just selling a put and selling a call. Some people will buy further out of the money options to hedge those. What I find is the added commission, by the way, I own the brokerage company, so I'm arguing against brokerage fees, but we want people to make money. The added fees in adding too many positions will really weigh against your profitability. So when you start doing condors, when you start doing multiple positions, the slippage and commissions can really hurt you, and you've got to really be cognizant of what they are, and that's why I don't recommend them. I prefer just to use the neutral position. I prefer to take the risk, the extra risk of going naked and using the rules that I have to protect me as much as possible. Which have worked for the last 14 years. So I don't do them. Ratio spreads are a three-legged position, but they do have such great profit potential, such high range of profitability that they are worthwhile. Ratio spreads I find definitely to be worthwhile. But the only positions I use, so the neutral positions I use quite a bit. Neutrals and ratios are probably close to 80% of my trading. We do another position, which is a combination of a neutral position and an option purchase, which we call a free option position, which we use in a trending market. We used it quite a bit in corn and soybeans at the beginning of this year, where we sell an out-of-the-money put and an out-of-the-money call. And in the case of soybeans and corn, we bought a better priced option. We bought a good call, near the money call, which was paid for by the 2 out-of-the-money options we sold. So that position will make money not only if the market goes in the way we predicted, which is higher, but the position will make money or at least break even if the market moves slightly lower or stays in the same range. So it has a much higher probability of profit. So that way we can get a trending market position and still have a high probability of profit. Those 3 positions are great. The calendar spread is a neat position. Maybe a good one is available once a year or twice a year, and it's still not a high profit item. So calendar spreads we have once every few months. Those positions are basically it as far as the strategies we use. Okay, there's a question over here. Yes.
The reverse of the ratio spread you were talking about, do you ever see opportunities like maybe gold right now, where instead of selling two of the out of the monies, you would sell the at the money or the near the money and buy two of the out of the monies? It's extremely low.
Right. Question is, would you buy in this extremely low volatility market? Would you sell the at the money option and buy two out of the money options? I don't. I don't do it. Just again, it's personal preference, because if you have a move in gold of $10, $15 in either direction, then you're a loser on that trade. And it's not wrong. It's just my own personal preference. And again, trading options, I find, is part art and part science. The science is what I've presented to you so far as probability of profit, time decay. That's all science. Premium, volatility, that's all science. And those are rules I can give you. Those are absolutes. The art form is something else, and it is something that I've developed over my 14 years of trading. And my art form is my comfortability with being short options. But that type of position, which is not wrong, is just not a comfortable position for me, because I feel that it is quite likely that gold could make a $10 or $15 move, which would cause a loss in that position. And although I feel gold's going to break out, I don't know when that's going to occur. So, for example, I think our hotline recommendation as of Thursday or Friday was buying a February gold 390 call on a move over 388 in gold, basis December. Buying a December silver 525 call if silver moves over 515. So we are looking at certain breakout levels that we would buy an option. Then we feel that if those breakout levels occur, we would be happy to go in the market. We feel there's some indication. And we're going to be paying up a little bit. We know that. We're not going to be getting the bottom tick. But there's nothing that indicates to me now that gold is going to make a move in something that gives me a high probability. Now, we have reasons in our newsletter, in our hotline, that we think gold could make a move. Gold stocks have made a move. There's other indications. Commercials are buying. But still not strong enough under our system to recommending buying those options. So we want to get trades that are profitable over the widest possible range, is generally our way of looking at things. Yes?
Two kind of unrelated things. One is, what's a reasonable expectation for rate of return on an options trading portfolio, and what advice do you have about diversification?
Good questions. Questions are, what are the rates of return to expect, and what do we do about diversification? On the rates of return, it's going to vary on your aggressiveness and how good you are. I mentioned we have not been recommending currency neutral positions. We have a group of traders that is making returns of 100 to 300% over the last year, doing what I haven't recommended to do. But they're taking significantly higher risk than I'd recommend. So it's going to vary, again, as to your ability, your aggressiveness, and your luck. So there's too much variance to really give you a figure. I would never quote a figure, because it's going to really depend on yourself. On diversification, you don't want to put all your eggs in one basket. And it's like I said about the coffee trade, where I really shut down our firm's coffee trading because I was concerned the huge number of positions. I mean, they were great positions. And everyone would look at me and say, well, how can I lose? And I said, well, I got too many of them to think about it. And you can take them somewhere else, but we're just at our, we had thousands and thousands and thousands of short coffee. I'm sure we had the largest position off floor, or maybe on floor, I don't know, of short coffee options. And there comes a point where I have to diversify for my firm's sake. And it's the same thing in your account. We had traders with $20,000, $30,000 accounts that wanted to put on hundreds of them because the margin was also low on these. You got to use. We do have figures in our book, but we say don't use more than 20 or 25% of your margin for any one commodity, and don't use more than 20% of your initial margin for any one position to give you plenty of room to adjust. They're shutting me off, so we're going to say thank you very much, and I will be available to talk to everyone after the lecture. Thank you.